eventually, because of the data, we could get back to where we were and get back to a terminal rate being repriced at 5.5, or expectations that we won't necessarily see, the cuts coming through in the second half? Because you could potentially take this as an aberrant event in terms of what we saw when it came to the three banks that went under.
Yeah, we look at it as you said, an extraneous event, and we still think the Fed is on the path and will not change their mantra to get inflation back to that 2% level. And as your previous guest mentioned, it's going to take a little while. You had the inflation figure, CPI came out, and it's still well above, and a lot of the, I don't want to say easy work has been done, but we've gone in getting the CPI down from 9 to 6. That's a lot easier than getting it down from 6 to even 3%. Yeah. So there's a lot of hard work that has to go on in there. And then, the one point I also like to make, because you hear a lot of people talking about, well, inflation is going down. No, it's not. It's not just not going up as fast as it was previously. And you'll see some lower inflation figures coming through in the summer when inflation peaked last year at 9%. You might see some slowing figures as you do the comparison in year over year, but it'll still be elevated, and we're not seeing much disinflation except for, as your previous guest mentioned, car prices, gas prices have come back down in that CPI report, but they've gone back up, in this month. So remains to be seen, and we feel that barring another extraneous event in the banking system, we expect the Fed to remain on its path to higher rates.
To higher rates, higher for longer. Give us your own sense, Kevin. How would you play the fixed income market from a duration standpoint at this juncture? Yeah,
we manage some assets for folks, and we've been keeping the duration short. It's just not worth it. We have investors that are looking at using the fixed income portion of their portfolio as a ballast. Didn't work so well last year, but we've been keeping folks, within that 2 to 5 year sector of the curve, where we feel we can generate some income there and employ a laddered strategy within there. So as bonds mature, if rates are higher, we can reinvest at higher rates. If rates are substantially lower, then their equity portfolio would obviously be substantially higher.